and others. Let's bring in Wells Fargo Investment Institute Senior Global Markets Strategist Scott Wren. Scott, good to have you. So the major averages closed down nearly 1% today, the NASDAQ faring worst. It's not a reaction to the 10-year, which was lower today. It's a reaction to oil?
Well, John, I think that's part of it. And, certainly the market, especially if we have a big jump, $90, $100 a barrel or something like that, that's going to be a negative. But I think a lot of what's going on right now is, stocks aren't cheap. We weren't all that far from the all-time record high. And a lot of people would say, well, gee, the fundamentals, we're slowing growth. Labor market's weakening a bit. Why would that be? So I think we had such a great move since the April lows. You've got a lot of geopolitical tensions out there. You have a lot of uncertainties. I think some people are just taking a little bit of money off the table. This Fed meeting, I'm very doubtful the Fed's going to do anything. I don't think the chair is going to change his tone a whole lot. So I think with the good run we've had, people are just more than willing to take a little money off the table, trim a little bit, and kind of go from there, see what happens.
But you seem to be saying don't take too much off the table, and you advise in international markets, investors should favor developed markets from here over emerging. Why?
Yeah. Well, I tell you, I think on if emerging, and of course China's the 800-pound gorilla there. We don't think that situation is going to turn much. We think the real estate market there is going to remain weak. Developed markets, they're cutting rates. If trade picks up here a little bit later this year and in 2026, they could do a little bit better. But, we're leaning toward U.S. assets. We have for a while. We think those are better quality. We think the U.S. economy in the long run is much more innovative, and the European economy isn't really all that innovative. So if we had to make the choice internationally, we'd take developed. But, for us, we want to be patient here. We certainly want to buy on some pullbacks. We think there's a good chance. I mean, this is not a bold call, but, easily from here you could see 5 or 10% to the downside. We'd want to be stepping into the sectors that we like, which would be energy, technology, communication services, financials. We even like utilities, though. So we're favorable on a number of sectors, but it's not like we want to jump right in here and buy them.
Scott, the debate is fomenting that if you want to take out the nuclear enrichment site that's buried half a mile deep into a mountain in Fargo in Iran, that it's going to require American-made so-called bunker buster bombs that are delivered by American-made B-2 bombers to actually get the job done. Unclear whether the U.S. would actually take that step that would directly involve it in an offensive way into this conflict between Israel and Iran. But if you were to see some sort of activities happen or evolve that would cause the U.S. to take an action like that, what does it mean for markets? What do investors, how do investors hedge that risk?
Yeah, let's face it, Morgan, you need certain planes to develop those kinds or to deliver those type of bonds. And I think for the market, at least in the near term, it all comes down to the price of oil, and the economies around the world are pretty slow, but a higher price of oil, and once again, $75 is not going to kill the economies around the world, but $120 oil certainly would, and not that would stick there very long. I mean, we like energy, but we're not married to that position. We see something, some super high price on oil, that'd probably be a good one to trim back. But I think that's, as far as the market goes, these geopolitical tensions historically, they come and go pretty quick. They're not long lasting. That's why we think if the market sells off, that's an opportunity to step in.